guys. Thanks for joining the webinar here. Looks like a few more people coming in. I could hear from the chimes. We're just going to wait a few more seconds. I'm already about 2 minutes late already, and we're probably going to get through this in about 15 to 20 minutes and leave some time for some questions at the end. So I think we should go ahead and just get started. First, I just want to say the reason we put this together is a lot of people are asking me they just want to get into lower risk things. People are being burned even in multifamily, stock market, but they still want to beat inflation. People are really wanting to preserve their capital right now as we go through probably another bear year. So that's why we created this corporate bond thing. We started about 6 or 7 months ago, and we're just now releasing it. And the goal is to beat inflation and maximize safer returns. So that's what corporate bond investing is. So let's go ahead and jump in. So what exactly are corporate bonds in the first place? Well, it's pretty much just like a debt obligation or an IOU. So you guys have probably borrowed money to buy a house or buy a car. That's almost the same thing that a bond is. It's basically a promise to repay. You see over here, commitment to pay interest on the principal, and then capital is returned upon maturity. So a bond has a set expiration date. Just like your car, okay, you might want to pay it after 5 years. The thing has to be up, something like that. It can be a fixed interest rate, which is nice to have in your portfolio. And the interest rate can be fixed, but sometimes it could be variable. So a lot of times when people are in bonds, especially like treasury bills, it floats based on the Fed rate. Also, you could have secured bonds or unsecured bonds. So what type of bonds are we going to talk about today? Only secured bonds and only fixed rate. That's the only things we're talking about today. So what type of bonds are there? Well, you got agency bonds, which you guys already know about, Fannie, Freddie, Mae. What about government bonds? You guys have heard of T-bills, municipal bonds. So most people have some of that in their portfolio. What about corporate bonds? So very few people have it. Probably more than 95% don't have it in there. So why should we invest in corporate bonds? Well, of course, you've got diversity. You can de-risk your portfolio, get some reliable income streams to balance out the riskier parts of your portfolio. And most importantly, everybody's trying to beat inflation. And some other bonds don't beat inflation, but we have ways to do that, and that's why we created this. And why are we talking about this now? Well, 2023 is the second best time in the last half a century to invest in corporate bonds. So we can actually get more revenue specifically from corporate bonds now than almost any time dating back to the 1980s. This is a chart that's really important. This is a high yield bond strategy versus Wall Street average stock fund. So the blue is the bond from 1989 to about 2020, and then you have S&P 500. Why did the bond fund beat S&P 500? So one thing that a lot of people don't talk about is, if you look here, this is the year like 1999 or 2000, you got a dip, and then you come back up here to break even. It's like 2005 or 6 before you break even. So people probably relieved, wow, the stock market was up after all these years. They went up a little bit more until 2008, and then you got another dip, a really deep dip. And then it took you how long to get back to square one? About 2013, 2014, 2015. So imagine from 2015 to about the year 1999, you really didn't make much progress, basically from here to here. So what people don't understand is if the stock market averages 6%, 8%, you pick your number. If you have a dip, let's say it's 50%, just to say a number, you had to double your return. You basically had to double your money just to get back to square one, right? If you have a 30% return, a 30% dip, which you're down 70%, is more than a 30% return to get back, right? Because what's 30% of 70 is 21. So if you had a 30% dip and then a 30% gain, you're only at 91% of where you started. So you need even more. You need like another 11, 12% return to get back to normal. It's like 40 something percent return to correct for a 30% dip. In the meantime, your money is losing value. So if you put add even 3% inflation in there over this period of 12, 15 years or whatever we calculated, is pretty bad for your portfolio. It's better off just to be consistent and miss the dips. So how big is the bond market? Well, first, how big is the S&P 500? So I'll let you guys just stop, think about it. Is it $1 billion? Is it 100 gazillion trillion? So take a guess, and I'm going to tell you the answer. All right, so let's look right here. About $34 trillion. Okay, so $34 trillion, S&P 500, bond market, 46 trillion in the United States. Okay, so that's pretty cool. It's not a niche, but people don't really know about it or how to get into this thing. There's also different bond types. You can get lower risk profiles compared to the stocks, less volatility, some stability, reduces the impact of market fluctuations, which we're seeing a lot of last year, and we're going to see it again this year because, as you guys probably already know from listening to any of my podcasts or if you're reading my blog articles, historically, whenever there's an election year, it's going to be a bear market. So, and that's another reason that's where bonds actually do well. And we have diversification, and we have the bonds are going out and being spread out over multiple companies. We're not just going to be all eggs in one basket. The problem for most is they don't have access to corporate bonds and high yield corporate bonds. Most of those are going to go to institutions that can write checks for 25 million, 50 million. So if somebody's coming in with $1 million plus or minus, they still can't even get into these corporate bonds until now, because Texas Corporate Bond Fund, where we are investing with experts into corporations, diversifying across multiple corporations, allowing investors to customize how they want their bonds. So it's not a cookie cutter investment here either. We have transparency through our portal, which some of you guys are already on there, so you get all your quarterly, annual reports and tax things in there. And also these yields are way higher than other bonds. How much higher? Well, we pretty much start at 8% on the low end, which outperforms the institutional high yield fund at 6.5 and the corporate income fund at 4.85. Now, I'm sure these numbers bounce around because not all of them are fixed. So a lot of these are actually floating. And where's the U.S. Treasury Intermediate Index Fund is about 2%. Even if it was double 4%, we're still doing a lot more than that. All right, so how can we pay this much? Well, brokers are cut out of the equation. So we don't have to pay broker fees on this. We also negotiate with corporations. So we can go to a corporation, we just ask them up front, hey, how much would you pay for X amount for your business? Those, of course, after we look at their financials and things like that. If they say 10%, I'll say, okay, well, we could maybe do something if you say 12, and a lot of times they say 12, because to them, the difference between 10 and 12 is not that much. They're more concerned with terms than the interest rate. Also, we go direct to the source. And also, we don't have the overhead of banks and all these layers of management. So all that rolls into the profits for the bond fund. And the great thing is you can decide yourself, do you want monthly coupons, monthly payments, or do you want this to compound for years and years and then pull out at the end and just pay capital gains? So now you can actually control the amount of taxes that you're paying. You can choose 2, 3, 5, and 7 year terms. And depending on how much you invest, you'll have an 8, 12, or 14% bond. So most of you guys already know me on this slide, just a little bit about me and my brother also, who is part of this. So as you guys know, I like to educate as much as possible, not even just on Zoom calls or one-on-one or in person like I have with you guys, but at a national level with my book, Make It Keep It, multiple virtual summits. My articles on Forbes are pretty educational. And luckily, because of that work, we've been featured in Entrepreneur, Yahoo Finance, and a lot of other podcasts and things like that. And over the last, basically since 2011 and now, probably approaching closer to $700 million worth of private projects that we've been a part of, transacted in, or required, including $20 million hard money lending fund, which is where I got my lending training. This is while I was with the broker-dealer. And $8 million fix and flip fund operations, where we learned a lot about operations and structure. A few of you guys have met my brother already. He runs a real estate development company here in Dallas, and he's also a UT graduate in business finance. He's won a couple awards during his schooling, and he has over 100 million AUM on the real estate side right now. He's been featured on TV, radio, podcasts, and has more than a decade of experience with construction developments and even consulting for other developers now. We're actually consulting at a national level with people in different cities and states. He likes to teach also. He's taught over 3,000 real estate investors through a group called the Real Alliance, which is actually how some of you guys found me, was actually through Comron. Now, I wish these guys were part of my team. Warren Buffett, for example, he's not part of my team, but he indirectly likes what we're doing. So bonds may not be exciting as stocks. I agree, they're not that exciting. They're a vital component of most portfolios. Bonds should be a part of every investment portfolio. John Paulson. Bonds are a great way to preserve capital, generate income. People that want to preserve capital and generate income, Ray Dalio says is a good idea. Bonds are for safety, stocks are for speculation. I think after 2022, people will agree about the speculation part. Basically, you buy, hold, and pray, hope that something goes up. Bonds are a promise to pay, important part of diversified portfolio. Now, another guy, Peter Lynch, he's saying it's boring also, but maybe boring is good this year and next year, and maybe for the next 5 years, 10 years, right? They provide stability and predictability in a world that's often unpredictable. So how do you guys get involved? Well, there's a couple of different ways. So we have 8, 12, and 14% bonds. Now, depending on the length of time you have the bond and how much money you put in, you could get larger returns over a longer period of time. So, for example, on the shorter spectrum, only 2 or 3 year bond, below 250K, there's 8%. 12% if you go above 250K and go a little bit longer, 3 to 5 year spectrum. And if you go all in here, 5 to 7 year term at 14%, that's $1 million and up. We only have a few of these slots actually, so if somebody wants this, just get on the phone with me sooner than later. But this one is great because the companies love it. They're willing to pay more if you give them a longer timeline, because let's say the company's profit margins are 40, 50%. They're compounding that every year. It definitely is worth them paying an extra 2% to give them time to compound that. So it's not highway robbery for these corporations that have really good profit margins. And you guys know you want to be in the blue, not in the red, right? S&P 500, Dow Jones, that's the speculative part of your portfolio. So how do people even invest in this thing? You go to bluescapital.com. People can invest now. You can schedule a call with me or JC or somebody on my team. But if you want, you could actually just go to the portal and everything will be there. If you got some questions after this Q&A session, you could just email me or text me. We'll get on a Zoom. And here's my calendar link right there, /number Calendly. And you'll see some options to book 15-minute call with me. And we're at the 15 mark. We're going to do maybe just a few question and answer things here and wrap this up. I know some people are already messaging in the chat, so let's take a look here. All right, so there's some simple question here too. Is minimum investment 100,000? Yes. So it starts at 100,000, and you could go up basically unlimited, but just $1 million plus. Like somebody wants to put in 2 million, okay, you can do that. You basically would buy 2 bonds at $1 million each, something like that. Along those same lines, you could stagger the bonds. You could have some in this bucket, some in this bucket. So if you vary the timelines, that's called bond staggering. I don't know if you guys have heard of that, but if you stagger your bonds, 2, 3, 5, 7 year, then as the years go by, you're getting a little bit of liquidity, and then you can readjust your portfolio. Then 1 or 2 years pass, you get some more liquidity, readjust your portfolio. And if it still makes sense to be in the bond, then go in there. Or if there's an emergency or you want to go into private equity or something like that, guess what? You're going to be liquid every 2-3 years. So that's another strategy as well. See, if I want to put in $1 million from the IRA, is that available? So somewhere on here I thought it said is IRA eligible, but yes, if you want to invest from your IRA, which only 2-3% of Americans know how to do that, you can actually invest from your IRA. If you guys don't know how to do that, I have an ebook on it I could send you, and we have a couple references of people that can make you guys VIP and get it done pretty quick, like within a week if you want. So just reach out to me. So basically what that is for people that don't know, most people's 401k, you're stuck with traditional investments, stocks, bonds, mutual funds. Not these bonds. We're talking about the other bonds like treasury bills, right? And the reason that is because either a financial advisor, nothing against them, although they have limited tools, but an advisor or your custodian only makes commission off of things that have all this insurance around it or has certain regulations, and they could sell it and take in a lot of money. Like if you give them $1 billion, they could put $1 billion in the S&P 500 and into treasury bills, right? But if you want to go into private investments, they won't allow it because they don't get commissions, and it's they don't even understand it. So what you do is you roll over your 401k without penalty, so you don't pay that 10% penalty like just pulling it out. You do a rollover, and the custodian gives you a checkbook even sometimes where you can just use your money and invest in anything outside of collectibles or art or annuities. That's the only things you really can invest in. If your friend down the street's building a lemonade stand, you can literally lend him $10,000 at 9% a year, and when he pays you back, it goes into your retirement account and grows tax deferred or sometimes tax free, depending on how you're set up. So yeah, I forgot to mention that. I probably should just make a whole slide on that. Let's see what else we got. Can you speak to the securitization on the corporations? Okay, this is another good question. Maybe I should have a slide on this. So when we do these corporate bonds, we do something called perfecting the bond. So what does this perfecting the bond mean? So we have a trustee that is not a part of Baluch Capital, not a part of my attorney group, nothing. They have nothing to do with this. But they actually represent the bondholders, and they actually sign off on UCC filings on these corporations. So what is a UCC filing? That means basically corporation wants 12-14% from the bond fund, then we put this UCC filing on it, which means if they have any real estate, let's say if it's a real estate developer, we have liens on everything. Wherever the money comes into the bank account, we own it now. They've got a printer at the office, we own the printer basically if they sell it. So they have accounts receivables coming in from some venture, okay, those are ours now. So we collateralize, the whole company is collateral, which makes us even safer. That's why usually corporate bonds have lower returns traditionally, because they're so low risk. In fact, the default rate, which maybe I should have talked about this too, the default rate is 4%, treasury bills is 2%. So we're talking about a pretty small difference in risk between treasury bills and this, but treasury bills I think are like at 3%, and you get up to 14%. That's like almost 5 times the return for a very minuscule increase in risk. And I would say even the risk you could argue that it's even lower with ours, because we're hand selecting these corporations and putting all these UCC filings. Not all bonds have UCC filings, and not all bonds are fixed, and not all bonds have the secured aspect to it. Some are unsecured bonds. So we've done everything to reduce the risk. So if the overall default rate is 3 or 4, maybe we're close to treasury bills around 1 or 2, although I can't prove that mathematically, but I'm just thinking in my mind we're trending in that direction because the way this is structured. So I even forgot what that question was, but yeah, something about the security of the bond. That's right. Okay, got it. Let's see what other questions we got. When is it open? So actually, today at 5 p.m. we should actually have the finalized documents. So we're literally just wrapping this up like right now. So and this one is a little bit limited, but the 8 and the 12%, we can do that all day long. Not all corporations are going to say okay to 14%, and we've actually already identified the first 5 to 8 million that we could lend out. So we've been working on that last half a year. Let's see what other questions we got here. Yeah, we mentioned that somebody's asking, can you put money in different bonds? Yeah, I actually think you should. That's a good way to control liquidity with that bond staggering. So that's what the bond staggering was. Let's see what else we got. This is a long paragraph here. So some of these other questions are pretty, like, I guess you'd say personalized to that person's portfolio and situation. So for those type of questions, just reach out to me individually. Just book a 15-minute Zoom with me, or you could email. It's better just get on a Zoom and knock it out in like 10, 15 minutes, whatever questions you guys have. It's probably the fastest way to do it, really. So just check it out, my calendar link, and we're actually a little bit past the 20 minutes. So let's end on that note. If you guys got questions, you know how to reach out to us. Go to BaluchCapital.com, # Calendly. You guys can text me, email me. You go to the website, reach me through there too. So that's all I got for you guys. All right. So let's see how this can fit in your portfolio, and we'll catch up with you guys later.